Hi, everybody. This is Mike Coppell, and I want to thank all of you for attending this webinar. And I want to make sure all of you know that we're going to be doing things a little differently this time. We've been in trouble with the audio from WebEx, so basically what we've done is we've discussed it with them and suggested that we do everything with voice over IP. Means that I'm going to be using the speakers in my computer, and all of the sound will come from the speakers on your computer, and basically you can plug in any headphones to your jacks if you don't have speakers on your computer. This webinar is a little bit different from some of the others that we've done, basically because what we now are talking about is a very, very technical area of tax, but one I think is extremely important. And what you see is that I have a subtitle here under active versus passive question, and I said is, will you be NII this? And basically what that talks about is, will you be subject to the net investment income tax because you are passive? And we're going to talk about that in a little bit of detail. That ugly picture, once again, for those of you who don't know me, along with my contact information, is my direct line here in the office. There's my cell phone number. There's my office email number. Those of you that don't know it, my personal email address, which you can always reach me at, is Mike, M-I-K-E, at the Coppells, THEKOPPELS.com, and you can always reach me at that, although I always also check my email. You may recognize this slide. I'm now putting it in all of the presentations that I do because I think it's really, really important that we remember as we talk about all the tax issues that we have going on. What is really important isn't the taxes, but the economics of a transaction. Taxes is very, very important. It is indeed where I live. We have to remember that economics in the final analysis is what rules. And as we look at transactions, yes, the taxes are very important, but we have to remember that in the final analysis, if something doesn't make economic sense, it only doesn't make tax sense. So, why is this topic so important that I decided to spend the time to write up this seminar, which is, as I said, it's extremely technical, and this is very simple. As those of you that came to our year-end tax seminars, and some of the other seminars know, there's a new tax in place this year called the net investment income tax for high-income people. As we've talked about yesterday when we talked about the new tax law, there are a lot of different definitions for rich or high-income people. In this situation, high-income people are still people with adjusted gross income of $200,000 and married filing joint income of $250,000. And again, remember that adjusted gross income, that's before exemptions and before itemized deductions. So what happens is that in certain situations, if you are passive in a pass-through activity, if you are passive in an S corporation, if you're passive in a partnership, then what's going to happen, if you exceed those limitations, what you're going to find is you're going to be subject to the additional 3.8% based upon the lesser of investment income amount or the amount in excess of high income, which is the $200,000, $250,000. So basically, think about what we're talking about here. What we're talking about here, potentially for some types of net investment income, for dividends, for example, we could be talking about, based upon what we now know, is 20% dividend rate for high-income people for that determination, which is the $400,000 and $450,000, which is now 20%, 3.8%. You could be talking about a 23.8% tax rate on dividends or capital gains for those people compared to a 15% in 2012. That's almost a 60% increase in the level of tax. This is really an important consideration. All right? And once again, the 3.8% interest applies to interest, dividends, rents, royalties, and capital gains other than capital gains from the sale of property, and as I put this in red, other than property, held in a trade or business is not passive. And this is why we're talking about passive, because what now comes into play, we're talking about trades or business, we're talking about operating businesses. If you are active in that trade or business, if you materially participate in that trade or business, you do not have the 3% additional tax. If you are passive in that trade or business, which means you do not materially participate, which is what we're going to be talking about, then you do indeed have an additional 3% tax on that income. All right. So, let's talk a little bit about the NII very quickly. First, you have to remember with regard to S corporations is that S corporations are a great opportunity to minimize NII. And that is because when you are a shareholder employee of an S corporation, your wages aren't subject to NII because they're going to be subject to the 0.9% tax, which we talked about at our year-end seminars, if you reach that level. And distributions from the S corporation on your K-1 are not going to be subject to the NII as long as you are active. If you are passive, then what is distributed on your K-1 will be subject to the NII. Now, in the partnership area, things get even more interesting. Hello? First thing that you have to remember is that in the partnership area, whatever way, if one person is treated as active, then both are treated as active. And that is going to apply regardless, even if the other spouse does not work at all in the business, is not all active in the business, because their spouse is active in the business, they by definition will be active in the business and will avoid the NII. And those of you that attended our year-end seminar, it is very, very important that when your partnership tax returns are prepared, that you make sure that you look on the top of page 5, at least it was on the top of page 5, and last year's partnership return, that you can look and there's a chart on the top of page 5. And the chart says basically what types of entities are active and what types of entities are passive when it comes to people that are partners in that partnership. What we're told by the IRS is that they're actually going to be looking at that chart, determining who is passive based upon what the entity says, and then comparing that to what's on what the partner reports. And they're going to say that the entity should know what's going on, and they're going to set a higher standard for making sure that the individual partner actually comes along with that or proves that that which is taken care of by the partnership is not correct. Right. Most of you are out there who have LLCs understand that we've been doing bifurcation, which means that we have taken and we have had the managing member of the LLC, both a managing member and a non-managing member. And as we'll talk about a little bit later, one of the reasons that we've been doing that is in order to make sure that that managing member is only taxed on their self-employment tax or their managing member portion, and they're not taxed their self-employment tax for the non-managing member portion. And the whole concept of bifurcation gets a little complicated and is not really in this area. It is designed to minimize self-employment tax and designed to minimize the 9.8%. Let's take one step back. One of the interesting areas that is also in here is that if a person has both a general partnership, a managing member partnership, in a limited partnership, a non-managing partnership, and they are participate. They are active as a manager, and we'll talk later that there is a difference between being active and being subject to self-employment tax. As long as they're active as the managing member, then that will also bring their non-managing member, their limited partnership interest, in, so they'll also be active in that and will be subject to the NII, the 3.8% tax. One of the things that we talk about with regard to partnerships and LLCs taxed as a partnership is the importance of having a guaranteed payment. And we believe very strongly that managing members and general partners should receive a guaranteed payment, which is designed to compensate them for their services, and every year we sit down and determine what that should be. We strongly recommend that partnership agreements and LLC operating agreements basically specifically indicate that the guaranteed payment for compensation for services be determined annually by a vote of the members or the partners, and we want that included right in the agreements. We'll talk later, towards the end of the discussion, about real estate professionals. They're good and bad in real estate professionals. As a real estate professional, we avoid the entire issue of passive for rental income. It brings up a serious question, however, when real estate is sold, whether or not that real estate will qualify for capital gains rates or whether it's going to qualify for ordinary income rates, and that's a huge difference. What is the difference between active and passive? Let's start off with Internal Revenue Code definition of who materially participates in an activity, which makes them active. And basically, an individual is active in a partnership, an individual materially participates in an activity if they on a regular, continuous, and substantial basis in the operations. One, we have no clue based on those words what that means. What the IRS has done is the IRS has given us very, very specific definitions of what qualifies based upon that definition. And there are 7 of them, and we're going to go through the 7 as we talk about. And please remember that they are very, very specific. This is what the IRS is looking for, and these, as soon as you reach one of these, you are golden. You have nothing else to prove. Item number 1. The taxpayer works 500 hours or more during the year in the activity. Notice I did not say business, I said activity. One of the really important things that we want to talk about, and it's a little bit beyond the scope of this discussion, is that what we can do here is we can break sometimes different operations, different businesses into multiple activities, or in some situations, we're able to take multiple businesses because of the similarity of the businesses, because they're interconnected, we can bring them together into one activity. And that is something that is very, very important as we talk about, do you want to be active or do you want to be passive in this area?
So let's get started.
All right.
As those of you that have heard me before,
does the taxpayer
I try and very hard
do substantially all the work in the activity?
You as
now, substantially is a funny word,
as political as you want, and
because
you want
substantially does not mean all. Substantially means almost all. So this particular case, basically what the case law has been indicating is substantially all really is 80%.
This is very hard for me as a tax
So that what we're saying here in item number 2 is does the taxpayer do 80% of all of the work in the activity? If that is the situation, then the person is by definition going to materially participate. They are
have an economic effect. It does have a business effect. And what we don't want to do is do something that has a
Now
part
we start to get
in it
even
and really
further
screws
down
up
the
your
line.
business.
We're no
Doesn't
longer
make
talking
business
about
sense.
having to provide
And it's very
almost
important as
all
we
the
talk
work
about
in the
these
business.
things,
We're
and
not
as we talk
talking about having to provide
with me, other
500
tax
hours.
professionals,
We're talking
other
about,
people from our
does
firm,
the taxpayer
you
work
understand that
more than
this is
100
important.
hours
If it
in the
doesn't make
activity
business
during the
sense,
year?
don't do it.
And
You
no
all
one
know how to get a
else
hold of me.
works
You all know where to
more
reach
than the
me
taxpayer.
in case you have any questions about anything.
Interesting part here, and we're going to talk about documentation in a minute. Time is pretty easy, and I'll talk about what is allowed
You have no
as
clue
documentation in a little while.
what
It's
is
usually
going to
pretty easy
happen
to document
in the next
the
3 or
hours
4
that
weeks.
you put in.
The latest thing I saw
How many hours
is that
you put in,
House
you
of
put in time sheets,
Representatives
you put in,
is
you have your
scheduled
calendar,
to
you have
recess
documentation
on
of
December
what you
14th.
put in. In order to qualify on this exemption, you not only have to document what you did, you're going to have to document what everyone else did as well. So this one is one that you really have to look at and say, does this make sense? Can I do this? The obvious advantage here is we're only talking about 100 hours.
Some of the
About
scenarios
the
that are
second half,
possible.
no one else works more than the
and talk
taxpayer.
specifics
So
about
this
a couple
clearly
of them.
has to be a
First
really
scenario I want to
small
talk about has to
activity
do with
in
charitable
order for this to
contributions.
work.
That is because
Number
one of
4,
the proposals that is on
is the
table
activity
is
a
to limit the
significant
amount of
participation
charitable
activity, and we'll talk about what
you
that
would
means
be
in a minute.
allowed
And some of
$2,000.
SPAs
So that means
in which
you
the
would
taxpayer
only be able
works
to deduct
between 100 and
$50
500 hours
of
exceeds a
state and
total
state
of
taxes,
500 hours
home
in
mortgage
a year.
interest,
So
charitable
what's
donations,
SPA?
etc.
SPA
capped at
is
$50,000.
significant
Now,
participation
for
passive
successful
activity.
business people or other
Is
people
any trade
of
or business
wealth,
activity
$50,000
in which you
especially
participate
come
for more than
from a
100 hours
high
during
income
the year,
state,
but does not
high
materially
income tax
participate.
state like
So what this allows you to do,
or New York
this
or
allows you to
California,
take a
$50,000
group activity
is a whole lot of money.
that you
So what
participate
happens
in,
here,
you not
may wind up
materially
being in a
participate in
situation where
any of them.
you want to make
You participate more than 100 hours in
what's going
each
to
of
happen
them,
is your charitable
and the
contributions
total of
wind up
all of
being
those
limited
is
along with everything
500
else.
hours.
Now, the
Now,
proposal
passive
let you carry
activity
those
came
charitable
into being,
contributions,
seems like
but if
long,
you're
long
making
ago anyway,
substantial charitable
back in
contributions, charitable
1986, back in the beginning
$100,000 or more.
So that
all of a
in
sudden,
the
this is a real
26
problem.
years that we've
So
been
one of
doing
the
this,
things that we
I
are
have never
discussing,
seen this happen.
With
Doesn't mean it doesn't happen. I've
really
spoken to people that have
sure,
seen it
even
and
though
done it,
tax
but
rates
I've
may
never
go up,
seen this particular
making sure
situation
you
occur
down this
where we
road
were able
and
to
you think
actually
that's what's going
document
to
all of
happen.
this.
You try to
Does
maximize
exist
your
as a
charitable
possibility.
contributions this year, even if you're doing it to
Five.
a private foundation.
And this one is really important for
Other
some
way
people.
that it may be
The
limited
taxpayer
is
materially
that what we
participated in
may
the activity
is that
in
the
any 5 of the
higher
prior
itemized
10 years.
deductions,
So what
the
this says
availability
is,
of
for
those may be
example,
limited. So perhaps
if
let's
somebody
suppose
participated
that your
for 5
marginal
years
tax rate
and then they,
is
for whatever reason,
39.6%,
went on
that
to
the
something
tax
else,
cuts have
retired,
expired wealthy.
moved
And
other
that's
activities
what's
or anything else,
gonna
they
The
still
proposal is
considered to materially participate as long as in
to
any of the
deduct those
5
charitable
years out of the last
to a
10
lower
years,
percentage.
they materially
For example,
participate.
the common number
So
thrown
this
around
would
is
allow
28%.
someone to
So
continue
basically,
to
you'll be
avoid the
losing a
NIR
significant
for
advantage.
5 years
So
after they
again,
stop
this is
participating in the
something that we
activity.
really have to
And we've seen
talk
this happen, and this is really, really important that people understand how this works and how powerful this particular situation can be.
Talk about what's happening, especially in the last week or week and a half.
Number 6,
Hopefully
the activity is a
going on.
personal service activity. A personal service activity is basically the professional trade.
Long ago, when I was
Accountant,
young,
lawyer, actuary, consultant, items like that. The activity is a personal service activity, and the taxpayer materially participated in that activity in 3 prior years. So, for example, here at Gray, where I'm cutting back a little bit, even though I'm cutting back, even if I have less hours than is necessary, because I have participated in that activity in any of the last 3 years, I will still be considered as materially participating and don't have to worry about any type of active or passive determination of any type of income that I may receive. And this can be really very, very important in a lot of situations that people talk about. Now comes the one that
the amount in excess of $25,000 is not deductible.
Based on all the facts and circumstances, the taxpayer participates in the activity on a regular, continuous, and substantial basis during such year. Well, that's great. That comes right out of the code, which we didn't know what it meant. However, this test only applies if the taxpayer works at least 100 hours in the activity and no one else works more hours than the taxpayer in the activity, which sounds like what we had previously. And this is the kicker, no one else receives compensation for managing the activity. So basically what this is saying is if you have a manager, right, that manager may not work for the activity, if you are paying them a management fee, for example, item number 7 will not apply. So this, once again, is a really, really complicated area. The situation that we see the vast majority of the time is item number 1. We can go flip back here to item number 1. All right, because this far and away is the one that we see the most, which is the taxpayer works 100 hours or more during the year. That's the first one that we see as being most important. The second one we see is that the taxpayer does substantially all of the activity in the situation. The pencil on the pad drawing a light bulb is very distracting.
Different address. I might have used my other office address because I had 2 offices.
Drawing the light bulb.
The office 7441.
All right. I don't know what that means.
187th Street, Cut Bay, Florida.
Okay. I apologize for that. I don't know what it means. It doesn't show up on my... oh, that was many slides ago. All right. So I understand what you're saying now. Okay. All right. Sometimes my cartoons can be a little distracting. I can understand that. I'll actually change that when I do this for when I'm doing further. So the big question now comes back to, all right, I understand the 7 tests. There are 7 tests. I understand that some of them are very hard to work with, and some of them are probably easy to work with. But let's talk about, all right, the IRS just walked in my door, and they said, all right, sir, you worked 500 hours in the activity. We all know that the IRS is very big on documentation. They look at our invoices, they look at our travel laws, they look at everything else in order to determine exactly how we are going to prove what we... Now, in this case, it is very specific. The IRS publication in this area says, and I quote, taxpayers may prove their hours of participation by any reasonable means, including but not limited to appointment books, calendars, and narrative summaries. I don't know what a narrative summary is. I do know what appointment books are, and I do know what calendars are, and I do know what timesheets are, and we have used timesheets, we've used appointment books and calendars very successfully in dealing with the IRS. Narrative summaries, when we write them up, the IRS then very often will come back and say, well, that narrative summary, unless you can back it up, unless you can actually document that which is happening, and it's maintained contemporaneously, they tend not to like narrative summaries unless they're contemporaneous. So I tend to tell people that it's much better to go and use your appointment books, use your calendars, especially in today's world where we carry around our tablets, my iPad, and we can keep track of all of our hours on calendars in our tablets, and basically that would give us all the documentation that we need in order to document hours, and that's what I strongly, strongly recommend that people do.
They're going to be much stricter.
Now, I want to go back. One of the things we talked about is a real estate professional. And the reason that we want to talk about real estate professional is rental real estate is by definition passive.
for
with a few exceptions.
$600 or more.
If you rent it less than 14 days and things along that line. But by and large, your rental real estate, your commercial real estate, your apartment buildings and so on, all of those things that are considered rental real estate are passive. One of the ways of getting out of passive for people that are truly involved in real estate is to become what's known as a real estate professional. And these are criteria for becoming a real estate professional. You have to own at least one interest in rental real estate. Two, more than half of your time, more than half of your personal services must perform in the trades or businesses of real estate during the year. So basically, trades or business of real estate means that you can be real estate management, you can be a real estate agent, you can do rental real estate, you can do anything that is involved with real property, and that will qualify as being involved in the trades or business of real estate. And lastly, the taxpayer performs more than 750 hours of service during the year in the real estate trades or business. And if you go back and you look at number 2, where basically it says more than half of the personal services you perform on real estate, that should make it so that you have more than 750 hours a year in that situation. I will tell you that the IRS tends to look at this with very jaundiced eye. The most recent case in this area is there was an attorney, a practicing attorney, who wanted to say that they were a real estate professional. And the IRS came in and they did this backwards. Instead of going in and saying, show me how many hours you performed as a real estate professional, they went at it and said, wait, stop. I want to see how many hours you spent as practicing attorney, which in that particular case was about 3,200 hours. They came along and said, we don't believe that you spent more than 750 hours, more than half of your services were performed in the real estate professions. If you were doing real estate, if you were doing your work as an attorney for 3,200 hours, and basically the person lost that case in court. But this is very, very powerful because it allows someone that has rental real estate to avoid being passive and avoid NII. Now, one caution that I have for people is that what it can do is take when you sell the real estate, and so that it is no longer capital gain, but what it now becomes is basically your profession. And now the IRS is going to start with, and they're going to say that if this is your profession, if your profession is real estate, they're going to tax the sale of your real estate as ordinary income and not capital gain. And that can go either way, and we've defended it in both ways successfully as to whether you are or not a real estate professional. And not every real estate professional is by definition a developer. It's only the developers of real estate actually lose the capital gains on their sale of real property. So that gets to be very, very interesting.
I will check on that and get back to the person that asked that question. Put it out in the black.
All of that is very, very important. And it's important because we have to remember that NII, the net investment income, 3.8% starts in 2013.
And the question is,
so that if you want to avoid, and I go back to my first slide, we want to make sure that there is a reason for doing things, all right? Not just to save tax, but it also makes economic sense. If you want to do it, it starts in 2013. Now is the time to start making sure that you've done what you need to do, you're recording time properly, and that you are sitting there and you're putting in the hours where they should be done. There's one other very interesting situation. When the rules first came out on passive activities, and then they came out over the course of about 10 years, basically what they said is, you have grouped your activities. Once you sit here and said, I'm taking these activities, which are similar in nature, and I'm putting them together into one activity to determine whether or not I materially participate. Once I make that decision, I cannot break that group up. I cannot go and regroup the activities. What this law allows us to do in 2013 only
2011.
is it allows us
The IRS
to
had a
regroup our
position,
activities
and basically
and
what they
break
did
up
is
our
they
activities
said
into
that
different groups,
if you as
merge
a
different
shareholder,
activities into different groups.
employee of an
This
S
is something that
take no
you have to sit down, you have to sit
Your
down with
wages
your tax
is
advisors,
clearly
people that
not
have multiple activities in which they
It makes
participate,
sense to say
and
that
see
if
whether or
somebody's
not it
taking no
makes
wages
sense
for
to
services
regroup
provided
your
to the
activities
corporation.
in
And what
order
they're doing
to
is they're doing all this in order
become
to avoid
materially
paying
participating
payroll tax.
or not materially
Is not
participating, depending
And
upon
they only
what
went
you want
after
to do in
people
the
that had
situation.
zero wages.
This is very
prior
important,
to
and this is
2011.
something that
In
no,
2011,
you don't have
they
to make a
changed their
decision
taxes.
until you actually
And they
file
went after
your
a
2013
specific
tax
S
returns
corporation.
during
And I am
2014.
embarrassed to say
I
that
believe
that
this
S
is a
corporation
discussion
was
that you should
CPA
be having early on, so
owner
that,
of
you
the
know,
CPA
as you're
firm, the
sitting
CPA
down and as
there,
you're doing
basically
doing your tax
$20,000 in
preparation
wages
for
and an excess
2012
of
in
$200,000.
2013,
in
you should be
a K1.
analyzing these activities,
And the IRS
determining
came in
whether or
and
not
said
they still make
it's
sense
not reasonable.
now that you have the
And
ability to
the
break things
CPA
apart and you can start all over
said,
again.
I'm going to fight you on this. And he took it
Um,
all the way up the ladder and actually
Now,
tried to
there's an
get
interesting
the
situation.
Supreme Court, the U.S. Supreme
Now,
Court, to
There are
step in.
several
The US Supreme
situations
Court just
with
recently,
limited
last 3
partners
weeks,
or
no, we
non-managing
will
members
not step in.
who the IRS
What
treats as limited partners
level court
can
said,
be
stand.
treated as
Therefore,
materially
what the
participating.
IRS is now,
The situation is,
the IRS
that, as we
clearly
mentioned earlier,
indicated to
their
us
spouse
that what they're going to do is they're going to be
their spouse
increasingly aggressive
is a
in going after
materially participates, and
shareholder
because you are
employees
filing a
where
joint
they
return,
believe
whatever you
those
do with
people
one
receive
spouse, if one spouse
their
materially participates, it's
wages
the other spouse by
We
definition
know.
materially
There is a
participates.
checklist, there is
The
there
other
are no
situation
guidelines,
is
there is nothing
if
to indicate
the spouse that is
what
a
is
limited
reasonable
partner
compensation
qualifies
for an individual.
under numbers
Now,
1,
what I
5,
tell
or
people
6,
is that
and we can
reasonable
forget 5 or
compensation
6 for a minute
is
because
actually
those
the
don't
same
happen
thing
very
as beauty.
often. Number 1 is
Beauty is the eye of
500
the
hours.
beholder. So is
If a
reasonable
limited
compensation.
partner
So
or
what you have to
non-managing
do here is
member,
you really have to take a look and
500
say, what
or
is
more
reasonable
hours
compensation?
into the activity,
Why am I bringing
basically,
this up
even
today?
though they are a limited
This is
partner,
important
they
because
can
what we
still
have
be
to
considered
remember
to be
is
materially
those of you that have
participating.
attended
They can
some
still
of
be
the other
actively
conferences
participating.
realize
Avoid
that
the
we are in a
NII.
situation today
Now,
where compensation,
all of this
compensation
is
exceeds
a lot to absorb. We can only spend a little bit of time, about a half hour doing it. It is extraordinarily complicated.
Next year in
This is what I'm
2013,
strongly
there is a
advising
new
everyone
tax
to do.
Tax on the individual.
Number
of
1,
0.9%
as you
for that
are
excess
taking
amount.
a look at
So
your tax
basically, the
return,
IRS
as you're
has an
preparing your
additional reason
information,
to
and
go
you
after
should
these
probably
people
start
because
by
in
actually
an S
going back and
corporation,
taking a look
the
at your
wages are
2011
considered
tax
earned income.
return.
That
And take a
which you
look and
receive on
see,
the
based
K1
upon the
is not
schedules,
considered
usually
earned
that are on
income,
the back of your
and
tax
therefore
return.
is not
It will
subject
tell
to
you
income
what
tax.
activities are
We
considered
expect to see
active
a
and
lot
which ones
more
are considered passive.
audits in
You
this
should
area.
take a look at
You
those
have to
that are
remember
considered
something.
active and
The
passive
amount of
and say, is
compensation
this really what I
an
want?
S corp
Is this the
shareholder
way I want
is
my
right on
taxes
the first
to be?
page of the return.
Sit down
The
with your
IRS
tax
doesn't have to
advisor,
work
sit
very
down
hard
with a financial
to figure
advisor,
out,
and say, does this accomplish what I want it to accomplish?
okay,
Is it going to do what I
see
want?
this
Does this give me the tax situation I
and the
want?
question
Does this
is,
give me the
can
economic
a partner
result
in
that
a
I want?
partnership or
Sit down
in
and
an
go through that with
LLC
them, and if
treated
it is
as a
not what I
partnership
want,
receive wages?
should I
And
be
the answer
changing
is no.
how I work? Should I change how I do it? Am I
Right.
maintaining the records? Am I
Long
maintaining
ago,
the calendar
prior to
in order to
2011,
document that which I'm trying to accomplish?
IRS has
Should I go through and
basically
regroup
what
my
they did is
activities
they said
in order to accomplish what I
if
want?
you as
And once
a
again, this is,
shareholder,
this
employee
is
of an
the old
S
saying,
corporation,
people
take
say,
no
don't try
wages,
this without a professional.
zero
Don't
wages
try and
is
do this by
clearly
yourself. Absolutely.
That makes sense.
Call your tax
it makes
professional.
sense to say that
Call
if they take
your
no
financial
wages,
professional.
the services provided
They don't know how to do this.
And what they're doing is
Have all
doing
of my
this in order
contact
to avoid
information.
paying
Do
payroll
get
taxes.
back to people as long as I'm around.
And they only went
I will
after
warn you
people
that the
had
wonderful
zero
Tina and
wages.
I
that was
won
prior
an
to
auction last
2011.
year and are
In
off to Cancun
2011,
on Thursday
they
for a week.
changed their tactics.
Don't
they
call me
went
that
after
week from Thursday to Wednesday, but
a
after that, give me a
specific
call,
S corporation.
and I'll be
And
happy to
I
help
am
you with any of
embarrassed
this,
to say
or
that
call
that
somebody else in our tax
corporation was
department,
CPA firm.
and they'll be
And
happy to help you.
basically, the owner of the CPA firm, the CPA
Remember,
there, basically took about
What I'm talking
$20,000
about here
away
to a large
and an
degree
excess
is the
of
number of hours.
$200,000
And
in
the earlier
K1
you start to document, the
The
earlier
IRS
you start
came
to
in
put
and
in
said,
the hours,
that is not
the easier it is to make sure
And
that you reach
the
the level of
CPA
whatever it is you want to
shareholder
accomplish.
said, I'm going to
Now,
fight you on this. And he took it all the
we
way
have
up the
two
ladder
different
and
things
actually
here, and
tried to
people
get the Supreme Court,
recognize
U.S.
that
Supreme
these
Court,
are two
yeah.
entirely
U.S. Supreme Court just
separate
recently, last 3 weeks,
Hang on.
said, no, we will not step in.
Let me read.
What the
The
lower
IRS
court said
distinguish
stands.
between different activities
For
within
what
the same
the IRS
business.
is now
For
doing
example,
is the
the
IRS has
professional
clearly
service
indicated
business
to us
also
that what they
invests
want to
in
do
various
is they're going to
financial
be
assets.
increasingly
The
aggressive
earnings of those financial
in going
assets treated as
after
active business
S-corp
because the
shareholder
person otherwise
employees
qualifies as an
where
active
they do not
participant.
believe
That's an
those
outstanding
will
question.
receive
And that question comes back to those of you that attended our
there are no
year-end
checklists,
tax
there are
seminars.
no
There's
guidelines.
something
There is
within
nothing to
the new
indicate
law,
what is
and this is
reasonable
all out
compensation
of the healthcare
for
law. There is
Now,
something in
what I
there
tell
that
people
said
is that reasonable
that
compensation
if
is
financial
actually the same thing
instruments
as beauty.
are part of the
He
operations
is in
of
the
a
eye of the
business,
beholder.
then
Reasonable
will
compensation.
make that
So
will
we
make
have
them
to do
follow
these.
what
You
it
really
is
have to
as
take
part
a
of
look
the operations
and say,
of the
what is
business.
reasonable
They would
compensation?
lose their character,
Why am I
interest, or
bringing this up
dividends,
today?
and for
This
the
is important
purposes
because
of
what
the
we have to
NII,
remember
they would
is
actually
those
be
of you
considered
that
the
attended
same as
some
the
of the other
operation of the business.
conferences, but
We are
that we are in a
anxiously
situation
waiting
today
for regulations in this area.
compensation
We are told the regulations will be out shortly.
$200,000
There
for a
are
single
draft
person,
regulations,
$250,000
proposed
for mass
regulations
filing
that the
joint.
IRS put out
Starting next year,
a few weeks ago on it. They're very controversial. There are comments on it, and the IRS has indicated that there are going to be changes in the area. Those changes should come out sometime in the first quarter of 2013, which means in the next few weeks. And when those come out and we know exactly what's coming down, we'll put out some information on that and see who this is coming from. And I know you very well. And when it comes out, I'll give you a call. And we'll talk about that specifically. It is something that is very, very important. It is something that we have talked about doing as far as maintaining financial assets in an operating business in order to avoid the NII. There are clearly going to be ways to do that. We're just waiting to see exactly what the IRS has to say about that. That's a very back to this slide. Basically, the material participation, the passive activity rules, and the self-employment tax rules, you would think that they would have something in common. And long ago,
one of the things that I'm
back in 1994, when the IRS first came out and tried to change the self-employment tax rules, they wanted to link up with the passive activity rules, and they were very quickly shouted down. And basically, the passive activity rules, self-employment rules are entirely different. Basically, there is no connection whatsoever between them. You can be self-employed, you can have self-employment income, you can have employment tax income, and still be active or passive in an activity. They have nothing to do with one another. And a lot of people think that is unfortunate, but that is the way it is. Make sure that you don't try and confuse
that works, or
I very quickly, and I want to bring this up, the repair regulations, as most of you that have that are blast emails know, the repair regulations, the capitalization regulation, whatever you want to call it, the effective date of that has been postponed until the start of 2014. However, in some situations, it's going to be beneficial for taxpayers to elect to use early adoption. This is especially true, and once again, this is a little bit complicated. This is especially going to be true for taxpayers with heavy capitalization, for taxpayers with a lot of dispositions of assets. For example, if you are in the real estate business, if you have an apartment complex and change the windows, or you fix the roof, or you've done something else, it may behoove you to do early election of the repair regulations. The other situation, and I was on a call yesterday, we discussed this. The other situation where it may make a lot of sense to do an early election here is if you know you made a mistake. One of the people on the phone on the conference call that we had about ACE, so they had a situation where people had made a mistake and they had used the wrong life for a situation. Because of that, they wanted to go in and change it retroactively and fix it, which the new regulations would allow them to do retroactively, whereas if they let it run, they would exceed the life that they had put down. And there's a funny thing about depreciation. Buried in the rules for depreciation is a concept called allowed or allowable. It means that if you make a mistake in your depreciation and depreciation should have been taken and you did not, you can lose it. So basically what we're talking about is if there is that type of situation, if you know it exists, it should be out there and you should take a look. Is NI tax separate in addition to the AMT surtax? The answer to that, unfortunately, is we think so. This is one of the other things that we're waiting for clarification on. The way that the NI is written is that the NI is a separate and distinct tax, and it is written as it is a surtax, and does not within the legislation say that it is a surtax on your regular tax. It says it is a surtax. And the way I'm reading that, and I reread it last night specifically because of the question, is it is going to apply both to your regular tax and your AMT, which is going to probably make sense considering that it is a surtax. But in any case, it is going to be an add-on tax to both. The way I read it, which is really unfortunate because basically what that means is that your alternative minimum tax is no longer a minimum tax. It is minimum tax plus your surtax for the NII. Again, as always, there are my contact information. Once again, personal email address is Mike, M-I-K-E, @thecopels.com, where you can always reach me. My cell phone number is there. I almost always have my cell phone with me. Mike and I, the wonderful Tina and I, were cross-country skiing up in Waterville last week, and in the middle of the woods, unfortunately my cell phone rang. I actually stopped to answer it, much to the embarrassment of my wife. Yeah, wherever I am, I almost always have my cell phone, and I will almost always answer it for you. If you have any other questions, feel free to call me or email me. Like I said, the one Tina and I are leaving for Cancun Thursday. We'll be back next Wednesday. I will be checking my email from Cancun. I do have a Skype account so that if it's important, I will get back to you. If there's anything else you need, feel free to give me a call or give me an email. I want to thank you guys for attending this. I know it's a little technical. It's a very technical area. It's something that you want to do. We're talking about this now because this is effective starting this year, and we want to make sure that people are aware of it. And if we want to make changes, we want to start on those changes very early. So thank you very much, and we'll talk to you again later.
Those of you